Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. The process of removing policy accommodation in current circumstances will involve both increases in the target range of the federal funds rate and reduction in the size of the Fed's balance sheet. As the FOMC noted in January, the Fed funds rate is our primary means of adjusting the stance of monetary policy. Reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. The administration, particularly the Treasury Department, so we provide technical background support and things like that. The near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war with sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. Maximum employment and price stability goals. Thank you. I look forward to your questions.
Supply chain constraints seem likely to only significantly increase as Russia invades Ukraine, and the full effect of our sanctions take hold. If the Fed's tools are mostly useful in stimulating or constraining demand, how can we expect monetary policy to rein in inflation that is largely driven by supply-side factors?
Our policies really cannot, as you point out, affect supply-side conditions. Our policies affect demand. What we're facing now is, though, an elevated level of demand in the face of supply-side constraints, and it's the collision of those two things that's creating inflation. So there is an important job for us to move away from these very highly stimulative monetary policy settings to a more normal level of rates and perhaps tighter at a time when inflation is highly elevated, and that is what the committee plans to do.
What are your thoughts going into the March meeting?
The March meeting, before the Ukraine invasion, the committee was set to raise our policy rate, the first of what was to be a series of raises expected for this year. Every meeting was live. Decisions would be based on incoming data and the evolving outlook. I also expected we'd make great progress on our plan to begin to shrink the balance sheet. And so the question now really is how the invasion of Ukraine, the ongoing war, the response from nations around the world, including sanctions, may have changed that expectation. And so it's too soon to say for sure, but for now I would say that we will proceed carefully along the lines of that plan. And weaker growth abroad. The thing is, we can't know how large or persistent. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward in the economy and with rates. I also expect that at this meeting we'll make good progress toward an agreement on a plan to shrink the balance sheet. We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting. We'll write down our new summary of economic projection, individual forecasts, which will show each participant. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. We use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think.
Cut off much of the Russian financial sector from SWIFT